Hi, this is George. In this video, we are going to see a few strategies of option selling. So the first one is Strangle. The second will be Straddle. These both are like non-direction strategies. Non-direction strategies are something when people have like no clue on where the market is headed. It may be bearish, it may be bullish. They don't have the exact like direction where it is going to go, whether it is a bullish or bearish market. And also this is like deployed when people are feeling that they have a neutral view on the market. That is like it will be range bound. It won't go beyond certain point in the upside or downside. So in these scenarios, they take these strategies. So let's see first about Strangle. And also one more thing, these strategies are like the basic strategies any trader who starts with, but we need not take this lightly because even the experts use this strategy on a daily basis. Okay, so let's go to the Strangle first. So if you see what is a Strangle is, in Strangle is it's a two-leg strategy in which they say like we need to hold a P and C, that is call and put option of the same underlying with different strikes. Let me just show you an example here. So this is the same application that I'm using. So this is an Strangle. If you see, I have taken two options. One is 17,800 call option and 16,800 put option. I have sold them both, and this is called as a payoff diagram, in which shows like today market is at 17 to 87. You will be profitable when till market goes to 16,590, 16,572. You can see the break even here. It is between 572 and 18,028. You will be profitable. The green zone represent that you will be profit when market is between like trading in this range till 31st of March. And if it crosses that range, your break even is breached and you will go to unlimited loss. You can see like the max profit can be 11,000, which is in this area, in this region. And the max loss can be unlimited because we are just selling. I have already told like once if you just sell, your risk is unlimited. So that is what it is saying. If suppose a market goes to 15,000, you can see you will be ended up with 76,000 loss. Similarly on the upside. So, but here the probability, as I have told, like always, the probability of profit in option selling is more. So here it is 62%. Here it is like only 10 days time frame is there. If you take a larger time frame, your probability of profit will be more, and your wide will be even more bigger. So this is called a short strangle. Now, short strangle versus long strangle. So as I have showed you, this is short strangle where we are like selling these two options. If suppose we are buying those two options, just the reverse would have happened. You would be in loss in this range of 15, the same thing, 16,572 to 18,028, and you will be profit once it reaches this level. And your profit will be unlimited, but here your probability of profit will be very less. And also, as I told you in the previous video, the margin or the premium, like if you have 11,000 rupees, you will be able to take the strategy of long strangle. But in case of short straddle, you need to have more margin. You can see like you need to have 1,15,000 to execute one strategy of strangle, that is selling both call and put of different strike prices. But here the probability of profit is more, but whereas in buying side probability of profit is less. So now coming to the next way, like how to make this unlimited risk into limited less risk. Like if we buy, that is what hedging comes in. So when you just sell a OTM call and put, which is a strangle, that is called naked short strangle because you don't have anything to cover your losses. But if you do a hedging by buying one OTM call and one OTM put further away from what you have sold, then it is called hedging, and the strategy becomes iron condor from strangle, and the payoff graph for that will look like this. See, you have done the same 16,800 put and 17,800 you have sold, and for protection you have bought 16,600 put and 18,000 call. So in this way, you are protecting your loss to the maximum range of 5,000, whereas your profit also has reduced to 4,000. Earlier, you can see your profit, max profit was somewhere around 11,500, but now that also has declined to 4,000. Also, one more thing you need to notice here, the break even also has declined. It is now 16,720 to 17,880, whereas it was 16,570 to 18,028, and that is the reason your probability has also declined. But one good side is like your loss will be like no matter where the market goes, your loss will be not more than 6,000, 5,962 to be in exact. So that is the reason. Generally, if you are neutral, like you don't have any view, it's better if you take a hedged position. It's not that only probability is 50% you end up in profit or not, but still it is like you are protected. And maybe if something happens, like we can always do some adjustments to make your positions into profit. That we'll see in the later videos. But for now, you have to have a hedged position so that you will not incur a unlimited loss. I'll just give you the difference between the short strangle and short iron condor. As I told you, this is like having unlimited risk but limited reward. Here it is limited risk, and the margin needed, I have not showed you iron condor's margin requirement. So here you saw like the margin needed was 1,15,000, but once you buy to call to contracts to protect your unlimited loss, your estimated margin goes down to 45,000 from 1,15,000. So thereby you are saving the margin benefit as well. And break even was wider when it was like only short strangle I have showed you, but now the break even has become narrow. And overnight risk, always they say like overnight, if suppose something happens, any like the Ukraine Russian war came that time, overnight there was a gap up of 2-3% in the indices. So in those cases, you can see like if you are having a hedged position, then you will be saved from a very bigger move in the market. So generally, it's better to use a short iron condor than short strangle. Even though we are using iron condor, the general term used here will be strangle only. Even in my videos, I'll be saying that a strangle with protection. I won't be using the term iron condor, or it is called as iron fly in the next case of straddle. But I'll be using the terminologies as straddle and strangle only. Now going to the next strategy is straddle. Here what you see is like the definition is involving holding CE and put, that is called the call and put option of the same underlying with same strike price. For strangle you would have seen like with a different strike price. I'll show you the payoff graph for this again. Here you see like the 17,300 of these are all like Nifty contracts. I have not told that before. These are like 17,300 of Nifty, 17,300 of Nifty again, call and put option. This is the underlying asset is Nifty. Nifty is trading at 7,287. The strangle we would have seen like 16,800 and 17,800 options we have taken, but here we are taking 17,300, which is the at the money contract. We are taking these both and we are selling them. You can see the margin money is higher than what short strangle was having. There it was 1.15. Here it is 1.38 lakhs, and probability is 52%, whereas there it was I think 61%. The reason is because the break even is here little lesser than there. Here it's 16,702, whereas it is 16,572 to 18,028, and it is 17,898 here. But the maximum profit is 29,000, almost 30,000 here, but there it was 11,000. The reason is because here, if you have predicted the market to be like range bound and it will go by only, it will end it by 17,300, and this like sharp V-shape graph shows you like if it is ending in this point, it will be like your profit is maximum at 17,300 at 29,000. But here you have a width, in this entire width your profit will be 11,000, but that is not the case here. It like for every move the P&L also moves. And similarly, like if we go to short strangle, short straddle is long straddle, just the opposite of short straddle here. You are buying the two contracts here, like a 17,300 call and put you are buying, and the exact inverse of what we saw in short straddle is going to happen here. Probability of profit here it was 52 something. It is 100 minus 52 is 47, and max loss is 29, and max profit is undefined, whereas here max loss was undefined and max profit was 29. And margin part it is 1.38 here, and anyway it is buying, so margin is only 29,000 here, almost 30,000 here. That is nothing but 311 plus 286 into the lot size of Nifty is 50. If you do that calculation, you will get this 30,000. Now, as I told you, if we add hedge by buying two, one call and one put option, for like out of the money of the ATM straddles that you are holding, you will be hedged, and that is called as iron fly. And the payoff diagram for Ironfly is this, where you can see like the break max profit is again from 29,000 it has reduced to 28,000, but max loss from undefined it has become only 6,000. But probability of profit has declined from 52% to 34%, and estimated margin has declined from 1.35 lakhs to 68,000 or 67,000, 68,500. So in this you can see like again the same like what we saw in Straddle. It is a V-shaped profit in the payoff graph where you'll get the max profit if it closes by 17,300 and it reduces as the market moves, but you will be capped by maximum loss of 6,500 wherever market goes. So these are the two strategies that I wanted to say as a beginner should know. I have given the same table here. I've just changed the heading here. Other than that, everything is remained the same. And if you see the difference between straddle and strangle, or this salient features, I will not say different because first point you can see like both are non-directional. And probability of profit is lesser in strangle because strangle you saw the break even width was lesser than what we saw for iron condor, and higher profit potential as you saw in the V-shaped P&L graph. If it ends at the peak of the V, you will have more profit, whereas it will be the same for Strangle. And margin needed was little higher for Straddle when compared to Strangle because we are doing ATM in Straddle and OTM, that is ATM is at the money and OTM is out of the money in Straddle and Strangle. Those terminologies we have seen in the last videos. So from next video, we are going to see how this, like when to enter the straddle and when to exit. And with the back testing that was done manually, we will see like what is the last 6 months data on when to enter and when to exit and when we will be making profit. Those things we will see in the next video. But for now, this is the basic strategy that one should know before doing any trade on option selling. Thank you.